Let's talk about liquidity ratios. Here is what I was going to say where you want to memorize these. You want to make sure you're familiar with these, possibly for other exams as well. These are liquidity ratios, how liquid the entity is going to be. Are you able to pay your debts? Can you cover your current liabilities with your current assets? Quick ratio, how quick, what if you wanted to just turn everything to cash right now? What could you turn to cash? Well, that's going to be cash and cash equivalents, short-term securities, and any receivables. Generally, things you could turn to cash within 30 days. And then your working capital ratio, just another ratio to take into account. These are all balance sheet ratios, hence liquidity. Liquidity comes with paying down your debt. Memorize these, be familiar, and understand the relationship. Because if a company does not have solid liquidity ratios, there may be a concern, a going concern issue. There could be an issue related to any debt covenants. You could see, we'll talk about that later, but you may see a debt covenant sim, something to be aware of, right? Something where if you're doing a compliance audit, the entity may need to maintain certain ratios in order to keep their debt from a debt service provider. Taking a look here at our other wonderful formulas, definitely, like I said, recommend memorizing these and referencing also, for example, where are these different components coming from? We see accounts receivable turnover. The numerator there is net sales. That comes from the income statement, whereas the average accounts receivable is an average of different balance sheet items. Obviously, we see sales net comes from income statement and then divide that by 365. So let's talk through what these different formulas represent for a company. Because first off, you need to understand, well, first off, memorize, right? As I said, then you need to understand why it's important and what it does for a company. And then similarly, you want to understand, is it better or worse to have a higher or lower one of these? Let me just say that again. Is it better to have a higher accounts receivable turnover ratio than a competitor or the industry average? Or is it worse? That's something very important. You could see that in a sim, right? You could say, okay, the sim could say, calculate all of these, give you a balance sheet and income statement. You have to solve for all of them, obviously give the right amount, and then say you're the auditor. You developed an expectation. The expectation, in this case, maybe it's lower. Is it better that the audit client has a higher accounts receivable turnover ratio than what you expected? And better meaning, is it just more preferable? A lot of different ways these sims could come about, as well as you could see these sims on other exams. Double counting, emphasizing these, want to make sure that you're familiar. First off, the accounts receivable turnover ratio. What does that mean? What does it represent? Well, this is going to represent the number of times that a company collects its accounts receivable during a given period. It's going to be calculated, as you see here, net sales divided by average accounts receivable. So you want to collect accounts receivable more. The more you can collect them, the more you can turn them into cash. So you want that to be higher. And also think about it. If your numerator is something that's, let's say, good, right? And your denominator is something that's bad, not saying average accounts receivable is bad. However, think about it that way. I mean, if you said sales to expenses, obviously a higher would be better because sales in the numerator is, lack of better terms, good. Expenses are, again, lack of better terms, bad. So just take that into account. Think about it in that sense. So this ratio is also used to measure the efficiency of the company's collection process as a whole and to assess the performance of its customers in making payments. So a better ratio would say that you're collecting your payments better and you've got a more efficient model going. Next up, we have the days sales in accounts receivable, also known as the DSO. DSO meaning days in sales outstanding, days of payables outstanding. How long are your sales outstanding for, right? And we see the calculation here. Now, what this is going to be, it's a measure of how quickly a company collects payments for the products and services it sells on credit, because generally we're not going to sell things and receive cash right away. We're going to sell things on credit. This ratio is going to represent how many days on average it takes the company to collect payments from its customers. So we see here, this is a days number. This gives you how many days, whereas other amounts are going to give you actual percentages. Again, important to keep in mind what gives you a dollar amount, what gives you a percentage, what gives you how many days, all different outputs from these potential formulas. Next up, the inventory turnover ratio. This is a measure of how quickly a company is selling and replacing its stock of goods. So you want to sell inventory quicker, right? That's definitely something you want to see. And this ratio, it's going to represent overall how well a company is at managing its inventory, and it can be used to compare the efficiency of different companies. The more efficient a company is, the better an inventory turnover ratio it will have. The days in inventory ratio, this is going to represent the average number of days that a company takes to sell its inventory. This is going to give an indication of how well the company is managing its inventory. And here, a lower ratio is going to be better. see ending inventory divided by expenses. Like we said, this is a quote unquote bad thing. So expenses, if they're lower, it's going to raise the overall ratio. We see here our operating cycle. That's our analytic we're going through. And this is going to be a measure of how quickly a company is able to convert its inventory into cash. It's going to be a measure of the efficiency of a company's internal financial operations. And we can compare this to competitors to see how efficient we are. Next up, the working capital turnover ratio. This is going to be a measure of a company's ability to convert its current assets to sales. And it's going to be an ability, right, to important indicator of a company's financial health as it highlights how well a company is using its resources to generate revenue. Next up, for our asset turnover ratio, this represents how efficiently a company is going to be utilizing its assets to generate sales. And a higher asset turnover ratio indicates that the company is generating more revenue with its assets, while a lower one may indicate that the company is underutilizing its assets. For our accounts payable turnover, this is a representative of the number of times a company pays its suppliers during a given period, and it provides an indication of how quickly a company is paying its suppliers. And in general, accounts payable, you want them outstanding longer. Because if they're outstanding longer, it means your cash is on hand for a longer period of time, right? You want receivables to be collected quicker, and you want payables to be paid in a longer period of time so you can keep your cash, invest it, do things such as that. Now, our days of payables outstanding, this is going to be a measure of how long it takes a company to pay its suppliers for goods and services that it's purchased on credit. It is going to be, as we see here, the ending accounts payable divided by cost of goods sold and 365 for the period. It's going to help to measure a company's liquidity and its ability to pay off its debts. Lastly, here, our cash conversion cycle. This takes into account three of other formulas, and this is just in general how long it takes us for a whole cycle of accounts receivable, right? That's us receiving money, days in inventory, how long it takes us to get rid of our inventory, turn it to cash, and then days of payables outstanding. So this is how long it takes us to turn our cash, make cash, right? So what do we have to do? We need to pay vendors to then get inventory, to then sell that inventory, and that is our whole process overall. A lot of great formulas. Definitely be as familiar as possible. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.